Think about commercial real estate as a diversified portfolio of various different property types, not just in the US, but in Europe. There is an opportunity someplace, somewhere in the world to add value through listed REITs, and we think that will continue.
Hello, welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. My guest today is Rich Hill, Global Head of Real Estate Research at Principal Asset Management. With more than 2 decades of commercial real estate experience, Rich is extremely well placed to provide insights into what's shaping the real estate markets today. So, Rich, thanks so much for joining me today. I know you've had a very hectic international travel schedule, so thanks for fitting us in.
It's a pleasure. It's good to see you again.
Rich, broadly speaking, how is listed real estate reacting in today's volatile markets? And where do you see returns heading over the medium to longer term?
Sure. It's a great question. I think heading into 2025, there was a lot of optimism about the broader U.S. commercial real estate market. Private commercial real estate returns had turned positive over the past several quarters, and listed REITs have rebounded pretty significantly since their trough in October of 2023, up more than 30%. The first several months of the year did quite fine, and then we had Liberation Day in early April, and that created a risk-off tone. I think if you would have asked a lot of people if we would have had all the events that occurred in 2025, how would listed REITs perform? I suspect a lot of people would have said, hey, look, this is not a good backdrop for U.S. listed REITs. Maybe they'll underperform. That is actually not what's happened. We view listed REITs in the United States and frankly in Europe, and I'm sure we can get into that, as resilient. Listed REITs are up around a little bit more than 2% through the beginning of early July of 2025. Not a home run year by any means, but I think they're doing what they're supposed to do, which is in environments like this, income returns are really valuable.
Great. And so it sounds like the general sentiment is fairly stable at this point.
Yeah, I think here's the way we think about listed REITs. Many times people view listed REITs and frankly commercial real estate as a singular asset class. But in reality, there are 18 different subsectors that fall under this broad umbrella. And we like to think that there's an opportunity somewhere, someplace in the US listed REIT ecosystem, regardless of the environment. So I think they're doing well. I think they're chugging along.
And what are you seeing in terms of public versus private valuations today? That's always a topic of interest for our audience.
Yeah, it's a really important question in our view. And the reason I say that is we are big believers that listed REITs are both leading indicators in both downturns and recoveries. As I mentioned to you previously, listed REITs troughed in October of 2023, and they're up handsomely since then, call it around 30-35% on a total return basis. That we think is the leading indicator for where the commercial real estate market is going. The private markets are just now beginning to catch up to that recovery. Private real estate valuations have turned positive on a total return basis over the past 3 quarters, but they're not anywhere close to what the signals of the listed REIT market are signaling. But I think you're asking a really important question about how do we think about returns in 2025. As I mentioned to you previously, we think listed REITs are leading indicators in both downturns and recoveries. If you look at the backdrop that tariffs, inflation, rising interest rates might have on the U.S. commercial real estate market, the natural indicator might be to say, well, there's going to be headwinds. We actually think U.S. private real estate valuations are going to be up around 5% in 2025, driven primarily by income returns, as capital returns will be relatively muted. If we look at what the signals the listed REIT market in the United States is sending us, they're sending us just that. We see U.S. listed REITs up around almost 3% year to date right now, which implies close to 5, maybe a little bit higher total returns for the full year.
Rich, in your view, are certain REIT sectors positioned to potentially benefit from possible market dislocation?
Yeah, sure. Look, public markets can be volatile over the near term, and they can be influenced by things other than fundamentals. But we try to take sort of maybe a little bit more of a medium to long-term view. Some of the sectors that we like in both the public and private sides are things like data centers, where we think that they have a significant technological tailwind. Senior housing has done really well. And many aspects of the housing market, including apartments and single-family rentals, as well as manufactured housing, are sectors that we think are really compelling. So happy to unpack all of that, but it comes back to my comment that, look, there's opportunities someplace, somewhere in the US listed REIT market. So when I'm looking at total returns this year, for instance, and as I told you, listed REITs are up around 3% year to date on a total return basis. Cell towers, which is a sector that we've long liked, are up almost 20% on a year to date basis. That's followed by things like triple nets, healthcare, residential mortgages, sectors that are actually starting to have some real tailwinds behind them. On the other end, some of the sectors that aren't doing as well are things like data centers on a year-to-date basis, but they're still doing quite well over the past 3 years. Lodging's trailed, office has trailed, maybe some of the more cyclical sectors as well.
And you touched on this a bit earlier, but can you talk about what you're seeing in terms of foreign fund flows into listed US real estate?
Yeah, there's a lot to unpack here. I would say heading into 2025, foreign investors were quite keen on investing in the U.S. commercial real estate market, both public and private. When I'm speaking to European investors right now, I think that they're starting to say, well, I need to have a little bit more of a globalized portfolio. You might read some headlines that European investors in particular are going to shy away from investing in the U.S. commercial real estate market, both public and private. I actually push back on that based upon the conversations that I'm having. I think investors are going to be a lot more selective and targeted on what sectors that they invest in, but there's still a real significant opportunity to invest in U.S. listed real estate because the sector's so big and it's really hard to ignore. I mean, you're talking about U.S. listed REITs being 60-70% of total global listed REITs. So it is a really important sector. Do I think that maybe Europe is having a little bit more of a focus? Yeah, probably. And you can see that when you look at European listed REITs. European listed REITs are up on a US dollar basis around 26%, and on a euro basis, they're up around 11%. So the public markets are sending you a signal that European listed REITs might not just be a deep value asset class like they've historically been, but maybe offer a little bit more growth. But where we stand on this is we think that there's a home for portfolios for both US listed REITs and European listed REITs.
Are there any particular US REIT sectors that these investors come to because they really can't get the same exposure locally?
Yeah, it's a super important question that I don't think enough people spend a lot of time on. So here's the way I frame the U.S. commercial real estate market. I like to tell people it's not my grandparents' commercial real estate market dominated by the core four, things like retail, multifamily, office, hotels. U.S. commercial real estate has actually become a much more diversified asset class over the past 10 to 15 years. It's actually emerged as a new economy asset class. So what do I mean by that? Well, 70% of U.S. listed REIT market cap is now in what we would consider to be alternatives or next generation asset types. Things like cell towers or data centers or seniors housing or single family rentals. These were asset classes that didn't really exist. And if they did exist, they didn't exist in scale over the past, call it 10 to 15 years ago. Those sectors are actually really hard to get exposure to in the private market for various different reasons, either because they're big dollar ticket property types like data centers, or they're operationally intensive like seniors housing, for instance. So we think that a lot of the reason that investors are attracted to the U.S. listed REIT market is because it does offer liquid exposure to these various different next generation property types. There's some of that in Europe, but the European markets are just now beginning to catch up.
Great. And Rich, could you talk about what you see as the key elements to really a resilient growth-oriented real estate investment portfolio today?
Yeah. So the market has become accustomed to believe that all that matters for commercial real estate, both listed and private, is interest rates. I get that because interest rates have been a huge component of what's driving valuations since the end of 2021. And in fact, the correlations between rates going up and listed REITs, maybe valuations having some headwinds, and rates going down and listed REITs having some tailwinds, have been quite high. I'll make a couple different comments here, but to begin with, we continue to believe that commercial real estate, both public and private, is a hedge against inflation. I'm often asked, why did listed REITs perform so poorly in 2022 and in a lot of 2023, despite our view that commercial real estate is still a hedge against inflation? It comes back down to the fact that what we dealt with over the past several years was stagflation, an environment where interest rates are rising and growth is slowing. That's not an environment that we see very often. The only time I've seen it in my career prior to recently was in 1Q05, and that ended up being a head fake. And prior to that, you have to go back to the 1970s. But interest rates are not all that matters for commercial real estate. Net operating income growth is really important. It's a big driver of income returns. Lending conditions are a really big driver of valuations. So when we look at the backdrop for U.S. commercial real estate, both listed and private, we actually think that we're on pretty sound footing. Net operating income growth is strong and above trend. Lending conditions are holding in there. And it looks like to us, interest rates have begun to stabilize. All of that leads to an environment where you can have stable returns, which we think is attractive for investing in U.S. listed REITs.
And Rich, are there any other trends or developments in listed real estate today that you're particularly likely to be following in the months ahead?
I would say the biggest developments that we're really looking at is, first of all, where are interest rates going? As much as I just said that interest rates are not all that matters, we do think that stability in interest rates would be a big driver of commercial real estate returns. But here's maybe two other interesting points. I'm asked often, how do you think about listed REITs versus private real estate? Do you like one versus the other? I sort of reject the premise of the question. I don't think it's an either or proposition. There's environments when you're supposed to be a little bit more overweight listed REITs versus private and vice versa. So what do I really mean by that? I actually think you're going to start to see investors merge the two portfolios together even more so than they have in the past. A lot of the reason is liquidity. I think private real estate investors have learned some hard lessons about having liquidity within their portfolio. Listed REITs provide that liquidity. But that's not all listed REITs do when you add them to a private portfolio of real estate. What else do they do? Well, believe it or not, adding listed REITs to a private portfolio of real estate actually reduces volatility. That's a little bit surprising and maybe a little bit counterintuitive to people because, look, listed REITs are more volatile than private real estate over the near term. But you can use that volatility to your advantage. Listed REITs tend to zig when private real estate is zagging. So it does smooth out your returns over time. It also has the potential to increase your returns over time. So bottom line, what does that really mean? Well, we advocate for having a 10 to 30% allocation to listed REITs within a private portfolio of real estate because we really do think it optimizes portfolios.
Excellent, Rich. We've covered lots of ground, but anything else that you'd like to add today?
The one point I would drive home is think about commercial real estate as a diversified portfolio of various different property types, not just in the U.S., but in Europe. There is an opportunity someplace, somewhere in the world to add value through listed REITs, and we think that will continue.
Rich, thanks so much for your time today.
No problem. It was good chatting with you.
And to our listeners, if you enjoyed this episode, please subscribe to the REIT Report on your favorite podcast platform.